I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Eric Hadik, president of InsideTrack.com. He works on cycles, and what kind of a cycle are we seeing in gold right now?
Well, I have been discussing this in my outlook for 2016. And really from just a very general, broad stroke perspective, I've been discussing since early last year that I thought 2016 would start out with the biggest advance that gold and silver have seen in 3 to 4 years, that it would be about a 3 to 6 month rally, but that would only be the first step in a developing bull market, and that it would still be a while before you saw any sort of parabolic moves higher, any sort of just unrestrained bullish fervor in the precious metals. I think it's going to make it very difficult on the gold bugs and bulls. Give them a little tease of what might be coming, but then correct sharply and cast a lot of doubt. So it's very typical for a bottoming process, and despite all the sensationalism that I read and get hit with from the gold bugs, I think that there's a very steady process that needs to unwind before the bull market really takes hold with more conviction than that.
Eric, isn't this really a part of the natural cycle? You just can't climb continuously.
Exactly, and it actually is indicative of a healthier market. And really, gold gave some critical and very revealing clues as it was going up in March and April. And those clues give both near-term indications and projections, and also confirmation of a developing reversal. And when you see a big move up like that, and in fact the recent surge in April, which kind of overlapped the talk of and the realization of the yuan-based gold fix on the Shanghai Gold Exchange, that type of action is very characteristic of a market nearing its initial extreme, not beginning a move like that. And that's what in a lot of interviews that I do, the gold is really the main focus, and often it's looking for that justification for just all-out gold euphoria. And the thing I tried to stress too was, even with that yuan-based gold fix, that was known, that was in the market. So just like a company that's getting ready to report earnings and expectations are already built in, that type of fundamental event usually occurs right before an initial top. It comes out, and the market responds a little bit more on that news, usually because there's been some Johnny-come-latelys that are waiting for a big flag to be flown and a neon sign to say, okay, it's time for the gold bull market. They jump in, that's usually your top. And it's that buy the rumor, sell the news type of structure. And that's exactly what we're seeing in gold. And as we just said, it's indicative of a healthy market, but that healthy market takes some time to shift from what had been a 4.5 year bear market since mid to late 2011, and it needs to set a base from which it can climb.
You picked a target figure of 1350, or I think, for gold. And
1310 is what
1310
to 1315 had been the upside target for the first 6 months of 2016.
How close did we get?
We got up to 1307, 1308. In fact, as we were pulling back in late March, early April, there were more intermediate objectives that I published and showed that there was a range from 1305 to 1315 where gold was very likely to reach and very likely to top out in late April, early May. So when we got up to that 1307, 1308, it fulfilled that almost perfectly, and did it when the cycles were showing we should see a peak. Along with that analysis, I was publishing that gold weekly cycles showed April 25th to the 29th should be the highest weekly close, and gold rallied it then and then spiked a little bit higher on the ensuing day, and then in the first couple of days of May gave an intermediate sell signal that I think was projecting a drop down to 1190 as a primary correction target, and that still is out a little bit in the future, but that's also part of that healthy correction mode that gold was expected to reach that level around 1310, but not exceed it until later on in 2016. And that's been one of those topics that not just bringing up now, it's been published since late 2015, early 2016. I've discussed it in half a dozen interviews or more in January and February. But that was really a key pivotal level for me. It incorporated a lot of different both resistance levels and upside objectives that would simultaneously show where a top was likely, but yet also confirm that a much longer term bottom was in place. So it's kind of that dual role that it plays, and it's textbook for a first wave advance in a bigger overall bull market. But it's also where a lot of traders get burned if they don't know what to look for and what to expect around that topping process.
Does this pattern match anything that we've seen recently?
In gold, not as much, because one of the things that I wanted to see from gold when I talked about it having its largest advance in 3 to 4 years, that's a signal to me that the tide has turned, and so you are entering a different type of wave structure. It now is the early phases of a bull market as opposed to later phases of a 4 to 5 year bear market. So we're starting to see a little bit different structure. Even the fact that you had what Elliott wave aficionados would identify as a pretty clear 5-wave advance into that late April, early May top. That is something that tells you it's more impulsive in nature, and when they use the term impulse, that just means in the direction of the overall larger trend. And that's usually followed by a 3-wave correction, something that has an initial sell-off, then a bounce, and then a second sell-off, comprising the overall correction. There are some key support and downside targets that come into play because of that structure, but it is more bullish and more impulse wave in nature than anything gold has seen since the 2011 peak. So even that is a good sign for the gold bugs. But patience is still necessary before a real sustained 6 to 12 month or 1 to 2 year advance really gets underway.
I saw the Venture Exchange Index was down a bit today, and it was also down the other day. Is this a good opportunity to buy junior gold miners?
One of the things that I stress in my analysis with precious metals is that, the gold and silver stocks certainly move in close concert with the price of the precious metals, but there are also periods of very significant divergence. And in fact, I did in a couple of special reports that we offer to new subscribers, one of the discussions in there has been really just laying out over the last 20 years the major turning points in gold and silver, and how at almost every one of them there is anywhere from a 9 to 18 month divergence between the actual price bottoms in the precious metal itself and the actual price bottoms or tops in the gold and silver stock indices, things like the XAU, things like GDX, GDXJ, and that's where the stock part of gold stocks comes into play very often, and it does also dovetail with my outlook for overall equity markets from now until late 2016, that they're going to see another down wave. So that tends to more significantly impact, obviously, the price of a gold stock as opposed to the price of gold. And there are even times where a sharp sell-off in the equity markets will spur a flight to quality into gold, and yet a lot of the miners and other gold-related shares will either be trading sidewards or selling off because of the weakness in the equity market. So I think that you have to have both of those factors coming into play, and that's what gold and silver and the miners had for the last few months, since the equity markets had that blow-off, sell-off into late January, and gold and silver cycles had already turned up in mid-December. That's when we really saw a 3 to 6 month buy signal triggered, basis my work. But it wasn't until after the equity markets had that sell-off into late January, and even some of them retested their lows in early February, then you took the pressure off of the mining shares. Then you were able to see them really skyrocket along with the advance that was already developing in gold and silver. But it took an extra month or so before a lot of the shares bottomed in that late January time frame, because the equities were having a bigger influence on them. And I think there's going to be a lot of that ebb and flow in 2016 because it's transitioning periods in both markets. It's transitioning to a more bearish structure and market in the equities and in shares, and transitioning to a more bullish phase in the actual precious metals. But in the midst of those transition periods, you have times when they're kind of moving in sync and times when they're moving at complete 180-degree opposition. And so I think that timing is definitely going to be the key for trading in any of those shares. And I think that there's a couple time frames a little farther out in 2016 when I think will be a much better scenario and situation and setup for another move up in gold shares.
We'll have more with Eric Hadik right after the break.
I'm Larry Ray, President and CEO of American Manganese Inc., listed on the TSX Venture, ticker symbol AMY, AMY, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Eric Hadik. Eric, what's your outlook for the equity markets?
Well, as I just touched on, I think that they are slowly transitioning into more of a bear market. And even though you don't see it in the Dow Industrials, and you never do until a bear market is, 50 or 60% already elapsed, it's just this magical wonder of the Dow Industrials that they stay positive, and they're the ones that the news media are constantly reporting, even as other indices are continuing to show signs of developing weakness. I think that we are within a few months of the time frame where a more pronounced and a more obvious decline is going to start to take hold. But I do see even the most significant portion of that down cycle waiting until late 2016 and then into 2017 to really take hold. And I've compared it since late 2014, early 2015, when I was first discussing why I thought you'd see a multi-year bear market start to take hold in equities. I kept comparing it to what the Dow Industrials looked like in 2000 to 2002, and I thought that we were going to see a pretty similar replay of that, at least for the first 12 to 18 months. I think things will start to separate after that period, but I thought that the first 12 to 18 months of this bear market would look much like if you pull up a Dow Industrial chart from January, February of 2000 all the way through July or so of 2001, and you see just an ongoing sequence of 2 to 3 month sell-offs. Those sell-offs usually barely break below the previous low and get some of the bears really emboldened and really deciding that the market's going to collapse, and then it turns on a dime. And then it rallies for 1 to 2 months, and at least in the industrials, gets back up almost to its previous high. And then you've got all the bulls just piling on and saying how it's going to this next level, 2,000 points higher. Lo and behold, it stops there, starts to roll over, and then sees another sell-off that just barely breaks below the previous low. And you kind of get the pattern I'm describing. I won't belabor it. But you just saw back in 2000 to 2001 almost an 18-month period of that, which was, for anyone just looking at the industrials, and again, that's often what your real basic investor is hearing in the media and is watching. It just looks like a sideways market. All the while, many of the other indices were breaking down and breaking down and breaking down, and then you finally hit that tipping point where the industrials can't hold up anymore. Any of the other lagging indices that are still trying to look bullish finally throw in the towel, and you see your sharper declines. That's what I've been expecting. That's what has really unfolded since May, June of last year. And I think it's what we're going to continue to see throughout the second quarter and third quarter of this year. And that analysis would be strongly validated if we see another sell-off into late June of this year. That's kind of the next key cycle that I'm watching. And there's some even more important price levels at that time that will either confirm what I'm looking for going out over the next 6 to 12 months, or tell me that the there's something not exactly right with my outlook. But on the whole, it's something where I'm looking for a steadily developing bear market that then starts to accelerate towards the end of this year and into 2017, accelerate to the downside.
How big of a correction do you expect?
I am still saying, I went on record back over a year ago saying that I thought by the time it was done that many of the key indices would see somewhere between 35 to 50% declines from their peak value. And, you know, whether that applies to the industrials or not, you can never tell, because that one is so not disproportionately, but it's very skewed to looking more positive, and the way that stocks are weighted and reweighted, it's very positively bent. But many of the other indices, I think that you're going to see ultimately 35 to 50% declines from their highs, and then you look around the globe, and particularly your Asian indices, which are particularly China, are leading some of these declines. They're one of the canary in the coal mine type of things that I've been watching, that even as the industrials saw this nice rally since late January, then you look at something like the Dow Transport, they saw a modest rebound, and then you look at some of the global indices, and particularly in China, they've seen a very tepid, at best, rebound, and they're already starting to swing back down towards their lows. They're not that far from their lows, and when they break those lows, I think that you'll see another accelerated sell-off. And when you look at the charts on like the Shanghai Composite, it's so indicative of a bubble bursting, and each time it has a downdraft, each time it sneezes, the rest of the global indices kind of catch a cold. And I think that the timing for the next sell-off like that is over the course of the next couple months, and that's one of those things that I think is going to kind of shift this developing bear market into the next year.
Eric, thank you very much for chatting with us.
It's been great coming back. Jim, thanks for having me again.
My guest has been Eric Hadik, president of InsideTrack.com, Inside spelled INSIIDE. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Comments or questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.